Amazon just dropped a $200 billion Capex bomb on 2026 and their stock got hammered. Wall Street is freaking out about the spending, but here's what they're missing. This is exactly what Amazon did with its delivery network over a decade ago, and it's turned into one of the biggest moats in business history. Today, I'll show you why this Capex is actually fantastic news and why right now is a serious buying opportunity for long-term investors. In the Q4 2025 report, Amazon reported strong numbers. Full year revenue hitting $716 billion, up over 12%. AWS delivered its fastest growth rate in over 13 quarters. 24% year over year in Q4 with an annualized run rate of $142 billion. But the headline that moved the stock was the guidance. Amazon plans to invest over $200 billion in Capex in 2026, up roughly 50% from the $132 billion that they spent in 2025. Most of that $200 billion of Capex is going to AWS in the form of AI infrastructure, data centers, their training chips, and much more. The stock is selling off because investors are worrying about the short-term pressure on free cash flow. But if we zoom out, let's see what it really means. This isn't Amazon's first big Capex cycle. Think back to the 2010s. Amazon poured billions of dollars into their fulfillment centers, into their sorting facilities, and into their logistics networks. For years, the fulfillment costs as a percentage of sales was actually rising as they built out the infrastructure. Critics called it reckless spending. It took almost a decade of heavy investing, but the payoffs have been enormous. Today, Amazon delivers same day or next day to almost the entire country. Fulfillment efficiencies have improved dramatically. Shipping costs have stabilized, and this new network is now a massive moat that almost no company on earth can compete with. This is the exact same playbook playing out with AWS and AI infrastructure. Here's the key difference that makes today's Capex cycle even more exciting. Demand is exploding ahead of the supply. AWS's backlog, their future committed revenue, surged to over $244 billion, up 40% year over year and 20% sequentially. That's real customer contracts for both the AI workloads and the traditional computing workloads. Amazon's CEO said that the demand for core services and their AI compute is so high that they're monetizing the capacity as fast as they can even build it. They've added a massive 3.9 gigawatts in the past 12 months, and that's still not even enough. This isn't a speculative driven build out, it's demand driven. They emphasize that they're expecting strong long-term return on their invested capital. That $200 billion Capex is primarily for AWS because that's what the customers are asking for. Short term, the higher depreciations and higher spending is going to put pressure on their margins and free cash flow, and that's why the price is dipping. Long term, this builds out the next decade's growth engine. AWS is already a $142 billion business that's growing at its fastest pace in years. The new AI investments are positioning Amazon to take advantage of the secular shift to cloud AI. History shows that Amazon's big infrastructure bets are a powerful compounding mechanism once they reach economies of scale. Plus, we haven't even mentioned the other parts of their business, like the retail side, which is continuing to get more efficient over time, the advertising, which has seen a 20% growth year over year, and they have other massive opportunities like their direct investments into OpenAI and Anthropic, their Starlink competitor Project Kuiper, and robotics, which could see a massive efficiency gain in the retail side. Each one of those additional investments could see their profits explode in the future. Ultimately, I believe that the post-earnings dip we're seeing right now is a great opportunity for patient investors. Amazon has executed this playbook before and has shown amazing returns, which is why I continue to add shares to my portfolio. It has become the biggest position that I have in my account, and it will continue to grow as long as people are going to keep selling me cheap shares. Amazon may have been sleepy over the past year to 2 years, but once this thing starts moving, I think people will be shocked. Amazon's $200 billion in Capex isn't reckless, it's discipline. It's the same long-term thinking that turned a bookseller into an e-commerce, cloud computing, and advertising powerhouse. The massive AWS backlog proves that the demand is there. Just like the delivery network played out, I believe this will be the same. For those with a long-term investment mindset, this dip seems to be one of the best buying opportunities that we've seen in Amazon in a long time. Let me know in the comments below what you think. Are you buying this Capex dip, or are you staying on the sidelines for now? If you want more breakdowns on individual stocks or bigger picture investing themes, hit that like button and subscribe. Thanks for watching and stay patient. Peace!